Bonjour à toutes et tous. C'est un grand plaisir d'être parmi vous aujourd'hui avec mes illustres panélistes et félicitations à la conférence de Montréal pour ces 3 derniers jours d'échange et de réseautage. It's my great pleasure to moderate this final panel today and for the conference. And of course, I'm delighted to be here in great company with Governor Macklem and President Nagel. A warm welcome to you both. Should I say bienvenue and willkommen. It has been an incredibly busy time for central banks over the last few years with a big shift in rate policy from material hiking in response to the biggest global inflation period in decades to now the great expectations of rate cuts. And so during this panel, what we're going to try and do is hear from our esteemed panelists around key lessons learned from this high inflation period, the current state of the economies in Canada, as well as the EU, resulting recent actions in monetary policy, and of course the key risk factors that they're keeping a very close eye on, including innovation. Now, before we start today's discussion, I would like to turn to Governor Macklem for opening remarks.
Bon après-midi et bonjour tout le monde. C'est toujours un grand plaisir d'être de retour à Montréal, ma ville natale. I'm thrilled to be here. I could not be more pleased to be here with my colleague, Governor Nagel from the Bundesbank in Germany. Thank you very much for visiting us, Joachim. Merci de votre visite au Canada. Vielen Dank, dass du uns Kanada besuchen. Since I'm on my home turf, let me start off with a few words about where we find ourselves in economic history. Canada and Germany have just been through the biggest inflation we've experienced in 40 years. And as painful as it has been, it has highlighted some lessons. And I'm going to focus on 3 in the Canadian context. First, we ignore the supply side of the economy at our peril. Premièrement, il est risqué de négliger l'offre dans l'économie. As central banks, we tend to focus on the demand side because that's what we influence with interest rates. But coming out of the pandemic, we've learned that it is much easier to restore demand than supply. High inflation was a stark reminder that supply shocks can accumulate and persist. And when they intersect with periods of strong demand, the inflationary consequences can be large. Looking ahead, technological change, geopolitical tensions, climate change, and shifting trade and investment flows all suggest we may experience more supply shocks than we did in the past. Businesses and central banks need to be prepared. Second, inflation is painful. That's not a new lesson, but for many of our citizens, this has been their first experience with high inflation, and it has been painful. L'inflation fait mal. Inflation harms people and the economy, and it corrodes trust in our market-based system. The rising cost of living has made life harder for everyone, especially those that had less to start with. People were working hard, but their paychecks didn't buy what they used to. That made people feel cheated, angry. Recent history has been a stark reminder that inflation is our common enemy. The third lesson is the value of central bank credibility and public trust. Troisièmement, la crédibilité des banques centrales et la confiance du public sont importants. We did not have that trust in the 70s, and the cost of unwinding inflation were high. This time, our track record on controlling inflation, combined with our forceful monetary response, brought inflation back down at much lower economic cost. But public trust and central bank credibility have been dented because of the post-pandemic inflation. To keep the trust we have and restore the trust we've lost, we need to continue to deliver for our citizens. And we need to communicate clearly and broadly. We need to find ways to explain ourselves to a wide range of audiences, from financial market participants and business owners to families and individuals trying to navigate in an uncertain world. We need to meet people where they are and ensure they understand what we're doing and why we're doing it. And that brings me to the present and the Bank of Canada's immediate focus. Monetary policy has cooled the economy, inflation's come down, and underlying inflation continues to ease gradually. Last week, the bank cut its policy rate by 25 basis points to 4.75%. With further and more sustained evidence that underlying inflation is easing, monetary policy no longer needed to be as restrictive as it has been. Cela vaut la peine de répéter. La semaine dernière, la Banque du Canada a baissé son taux directeur de 25 points de base pour le faire passer à 4,75%. Puisque les données indiquent un ralentissement de l'inflation sous-jacente sont de plus en plus nombreuses et constantes, la politique monétaire n'a plus besoin d'être aussi restrictive. And last week, the ECB, of course, also lowered its policy rate. I expect more on that soon. We have come a long way in our collective fight against inflation. Looking ahead, we still need to get inflation down further to our targets. And I will say that the shared resolve to restore price stability across major central banks has helped us all get inflation down at lower economic costs. We've also learned some lessons from the post-pandemic inflation, and we will take those to heart. But the challenges of the future are rarely the same as those of the past. Supply shocks are likely to be more important going forward. New technologies not only have the potential to increase productivity and prosperity, but also to disrupt. Interest rates may be easing in many economies, but global interest rates are probably not returning to pre-pandemic levels. The new normal won't be the old normal. And if we're not going back, well, we all have to adjust. These shared challenges are why discussions like the one we're having today are so important. They help us all navigate in a new world. I'm looking forward to the discussion. Merci beaucoup.
Thank you very much, Governor. Indeed, it has been a time of material adjustment at personal and business level as well. And so there's a lot to talk about the new normal that you just alluded to. So let me start with you, President Nagel. Last week, it was the first cut in rates since September 2019. Could you walk us through the state of the economy that drove that decision, the path that you see ahead, and of course, the key risk factors that you're keeping a close eye on?
So I'm trying to do my best. But first, Tiff, thank you very much for your kind words. It's my first time here in Montreal, so it's a real honor, privilege to attend to this conference. Coming back to your question, I think the storyline in the Eurosystem is a little bit different from Canada. I think, just to give you a little bit my thoughts about this, when I became president of the Bundesbank in January 2022, during that time, I think most of the central bankers, we thought that inflation might be transitory. But the truth is, we learned it was not transitory, and is not transitory. It is something that might stay for a while, but we are on a good path to bring inflation down to our target. But in the Eurosystem, then the game changer came with the war that occurred in February 2022, really a game changer, a structural break, I think a black swan. We just came out of the pandemic. We had still the supply constraints, these bottlenecks. And then on top, this war, and Germany learned the lesson hard. I think when you think about the Russian gas, so more than 50% of the Russian gas came to Germany. So the German used 50% of the gas that came from Russia. So we're trying to overcome this crisis. So energy crisis went up 300 euros for megawatt gas. So it was really a challenging, not challenging is not the right word. It was really something very outstanding. So it was really a herd of black swans. It was not just one black swan. It was all came together. So it was really challenging for monetary policy. And you have to think about how the euro system is working. We are 20 different countries, big ones like Germany, very small ones like Malta. 26 people are sitting around the table. So it's really, we have to come to compromise, find a kind of an agreement. And I believe that we did it pretty well over the last 2.5 years. We hiked 10 times. I think if you would have asked me in 2022, is that possible? I would say, well, maybe, but I wouldn't be so sure about that. And really, we tried to do this in a way that I believe was really a good achievement. And we brought inflation down. So I guess the good news is that inflation is going down. It's coming down. Yes, it's true that core inflation is still very sticky. But when we lowered interest rate the first time last week, it was our understanding that the direction is the right one. Yes, the projections we released last week gave us a little bit, again, the indication that we are on a bumpy road. But we all know that the last mile is the most complicated one. And so I believe the best approach is here, and we said this many, many times, we will think from meeting to meeting. This is the famous meeting to meeting approach. And I guess it's the best way how to handle monetary policy in these complicated days. And it's still a very opaque situation that the information is very, let me say, that we receive is changing. The geopolitical situation is very, let me say, also difficult to say it in a polite way. And so we have to wait what will be coming next. What is the new data giving us as a new indication? But the good news is that inflation is coming down.
So it sounds like it's going to be a data-dependent path, meeting to meeting, with all the different factors really influencing.
So what I try to explain to you, maybe using a picture, we are not on a mountain top. We are more on a mountain ridge, and now we are trying to find a way, in a way, let me say, cautious way, to find a good descent from this mountain ridge. And this is I think this is the best way to put it. I think this is a very, let me say, thoughtful way how to deal with these challenges and how monetary policy should act in these days.
And I did see an interview published yesterday by President Lagarde, where she said that she did not exclude the possibility of having multiple meetings between one rate cut and another. So,
as always, I couldn't agree more. I think this is my understanding from the beginning. I think we shouldn't be too overconfident, too over-optimistic. I think we learned it in a way over the last 2 years that it's the best way to be not complacent, really think through all the things in a very thoughtful way. And so, as Christine said in her statement, I guess that is not, we are not on a autopilot when it comes to rate cuts. I think we, as I said, and I have to allude to that again, we are really in that understanding that the best way to deal with this is a meeting-to-meeting approach.
So I'm hearing gradualism, caution, data dependency. Thank you so much. Governor Macklem, let's bring it closer to home. The Bank of Canada decided to cut rates last week as well. Could you lay it out for us in terms of the key factors that drove to that decision, the path ahead here in Canada, and the risk factors that you're keeping an eye on?
In terms of the decision itself, if you go back several months, we've been saying that we wanted to see further and sustained declines in underlying inflation. And if you look over the past number of months, CPI inflation has consistently ticked down. More importantly, if you look at our measures of core inflation that strip out the more volatile components, they have been steadily, gradually coming down on a year-over-year basis, and particularly the more timely 3 months measures have come down, which suggests there is some further downward momentum. The other thing we look at is we look at the full distribution of price changes. And if you look at, one measure is what's the share of CPI components that are rising faster than 3%? That went up very high when inflation was high. It's come back down, and it's pretty close to its normal level now. So what that's telling you is that inflation is not unusually broad-based anymore. Combined with that, the fact that the economy in the second half of last year was quite weak, growth close to zero on average in the second half of last year. Economy moved in excess supply. That excess supply is relieving price pressures. So that all told us a couple of things. It increased our confidence that inflation's coming down. It increased our confidence that we're going to move closer to that 2% target. There are lots of uncertainties. It's not a done deal, but with that increased confidence, our assessment was monetary policy no longer needed to be as restrictive as it has been. It is still restrictive. We're still above target. We still need restrictive monetary policy, but not as restrictive. Now, going forward always gets trickier. There are a lot of unknowns. What I can say is that if the economy evolves broadly in line with our own forecast, if inflation continues to ease, underlying inflation continues to come down, it is reasonable to expect further interest rate cuts. But as Governor Nagel just outlined, we're very much in the same vein. We're going to be taking it one meeting at a time. The timing of any further cuts are going to depend on incoming data, and importantly on what we think that data means for the future path of inflation. We've come a long way. We're not there yet, and we're resolved to complete the job.
Well, and certainly many factors to keep a very close eye on. There are 4 remaining interest rate announcement dates in 2024. So I guess there's more action to come, or lack thereof. We will see. Moving to the next question, and maybe I'll come back to you, President Nagel, because you did a very interesting speech late last year around, and I'll quote, "Sound public finances make life easier for monetary policy." And so what do you see, what is important when it comes to fiscal policy, and are there certain adjustments that are needed on the fiscal policy side in support of monetary policy?
Before I answer this question, let me just add something that Tiff said about inflation and how, let me say, complicated it is in a situation when inflation went to levels that we had over the last 2 years. Take the European numbers, we were above 10%. I think the last time we had similar numbers in Germany was in 1951 because of completely different reasons. So just to give you a little bit of flavor how the perception was not only here in Canada, also in Europe, everywhere. And so it was really now the job of central banks to bring this inflation level down to more, let me say, decent levels. And so this was the most important thing what we can do as central bankers. This is the best, let me say, thing that you can do for an economy in a situation where inflation was so high. But coming back to a question, and this brings me to fiscal policy. I think it is true that monetary policy has a clear mandate. This is price stability. But when fiscal policy has a certain probability to work against what we do on the monetary policy side, this is not a good combination. And so, especially when you are in the Eurozone, in the European Union, I think you have 27 countries in the European Union. I think this is, from a central bank perspective, it is more or less on a daily basis what you have to address and say, well, look, we can do our job, but fiscal policy has also a very important responsibility. And yes, I do have some concerns that fiscal, and I believe especially after the European election from the last weekend and what might come up when the new Commission is in place, I think it is a responsibility to really find a proper and sound level of that fiscal policy is representing for the whole European Union. And this is a task that I expect from the new European Commission, that they have to work on that.
Yeah, I mean, I think we can all agree that sound public finances are key to strengthening countries' resilience to crises, and there will be other crises looking ahead. We just don't know exactly what they're going to look like, but we need to be ready.
And it's not only just fiscal policy. I think it is true that all the challenges that are ahead of us, or what we have to do when it comes to the decarbonization of the economy, all the structural challenges we have in Europe, it's about digitalization, demography. It's not just only, we think in the first way, we're thinking about what fiscal policy can do. But I guess we have to think more about what can we do to mobilize private capital to really finance all these challenges that I just alluded to, because public money at the end will definitely not be enough. And if we ask in any case that fiscal should do more, I think this is I think in my interpretation as a central banker, this is not the right approach.
Well, thank you for that. And you mentioned the EU parliamentary elections. I guess, well, the overall results were largely as expected. The European far right has gone mainstream and confirming a trend that has been evident for some time. So looking from afar from here would suggest a more complex environment overall on a number of fronts, and potentially when it comes to the complexities around the fiscal policy as well. There is another very important question and topic for us to touch on, and it's the divergence from the Fed. So at 2 p.m. today, the Fed announced its decision to keep rates unchanged, and so the divergence is reaffirmed. And this has occurred in the past, and ultimately there was a convergence. So it would be great to hear your comments on that. It is the first time in history that the ECB has started cutting cycle before the US Fed. What happens in the US matters for both Canada as well as the EU. So how do you think about the spillover from the US into monetary policy decisions? And Governor Macklem, maybe we could start with you.
Well, look, the U.S. economy and the Canadian economy are very integrated. We're obviously very integrated in trade. The U.S. is the main destination of Canadian exports, and what less people know is that Canada is the main destination for U.S. exports. Obviously, our financial markets are even more integrated. So what happens in the United States has a big impact on Canada, both in terms of our real economy and our financial markets. But I would stress we have our own currency in Canada. We have a flexible exchange rate. The flexible exchange rate is the shock absorber, and it's what allows us in Canada to gear monetary policy for what's needed in Canada. And we cut rates last week. The U.S. has clearly, inflation's been stickier. They didn't cut today. They signaled that there's a new dot plot out. You've all seen markets moved, and that isn't. Markets are absorbing that. Markets can see inflation has been less sticky in the Canadian economy. I think monetary policy has had more traction in the Canadian economy. Our economy in the second half of last year was weaker. There are limits to that divergence in interest rates, but we're not close to that limit. And the flexible exchange rate system is working. Markets are working.
Thank you.
I think in the case of the euro system, it's pretty much the same. I think first of all, we are doing monetary policy for the euro system. I think this is our mandate. This is our job. This is the reason why we are independent central banks. But it is true that even when I had to more or less refer to our mandate, it is clear that there are spillovers from the United States to Europe. It's more or less reflected within the models that we are using for our forecasting. So it is crystal clear that things that are going on in the United States, in Canada, have them, let me say, there's a kind of a feedback loop. And this is also influencing monetary policy of the euro system, but in a more indirect way. So I have to emphasize on this aspect that the root causes for inflation in the United States were different from Europe. I think in the United States, it was more a combination of demand and supply-driven factors. In Europe, it was more supply-driven story. So it was not only the spillovers that are coming to Europe in an indirect way. We have to take into account that the reasons for the inflation story in Europe were different from the United States. So I was not too much surprised that taking this as the analysis for the inflation story, that we went this time, the first time, by cutting rates, what we did last week. And the truth is that inflation, and this is the same in the United States, and it's the same in the European Union, that inflation is sticky. It is a stubborn phenomenon. And so I believe that central banks on both sides of the Atlantic have to be even more stubborn than the inflation story. So I believe this is a similarity that I see comparing the Fed policy with the policy of the Eurosystem.
Well, look, there were many not surprised, for sure, by their decision today that they would not cut. For those that might not have seen the Fed statement, key highlights are around modest progress towards 2% inflation objective. Inflation remains elevated, and so will be a key continued area of focus for them. And the median dot shows now potentially only one cut in 2024. À suivre. Let's take a look at inflation in a broader context. So when it comes to the inflation target rate, both the Bank of Canada and the ECB are targeting 2%. And so President Nagel, you again spoke last month about what's next for inflation and the post-pandemic inflation factors. And you touched a bit earlier on decarbonization, but there's also the geopolitical uncertainties and demographics. Could you comment on these factors at play here and how they could impact inflation going forward and certainly ultimately then monetary policy as a result?
Yes, I think these are the big unknowns. And the truth is, we do not really know what impact might come from all the structural issues that I already mentioned, like demographic digitalization, decarbonization. I think there are several, let me say, empirical works out there that are trying to identify what could be the impact. And my gut feeling is that it could be the case that all these structural elements might push a little bit inflation to a more elevated level. But as I said, it's still an open question. So we have to be, as I said, in this very uncertain world, we have to be very cautious, not showing any complacency in our mandate to fight against inflation. And the job is not done. I once described inflation as a greedy beast. And now we are in a situation that we tamed this greedy beast. But our job, as I just said, is not done. We have to really be, let me say, very focused on what we have to do for the next 12 months. And then I'm rather confident, despite the structural elements that are triggering maybe higher, that have the potential for a higher inflation potential. Despite that, I guess we will succeed at the end.
So sounds like more research and more analysis to be done around these.
I think it is too early.
Yeah.
I think this is for sure. I think because we are living in a situation where so many factors are kicking in. It's not just the structural issues. We have all the geopolitical questions that are unsolved. We have, I think, the best way to get a little bit more, let me say, confidence would be that Russia is ending this horrible war in Ukraine. It's not only best for us in Europe, I think it would be for the whole world. It makes me, to say that in a very blunt way, crazy that we are spending so much money, time, waste of time for this, let me say, horrible war. And this brought us all in this situation, and we shouldn't forget that. And let me remind you, last week we celebrated the 80th anniversary of the D-Day. And I said it last week in the Governing Council. And especially for us Germans, it is something very special. We look back 80 years of peace in Europe, in the European Union at least. And now we are in a situation that is completely different since the 24th of February. So monetary policy in these days, I have often the feeling, is easy compared to all the other challenges that are around us.
No, indeed, that's certainly a very difficult situation. Bringing it closer to home, Governor Macklem, we face these factors here as well. And a topic that's critical to Canada's ability to navigate a future that's more potentially prone to inflation is productivity. And so back in March, the Bank of Canada issued a very stark warning about the country's weak labor productivity, low levels of business investment, and saying and calling the situation as an emergency. The quote was, "It's time to break the glass." So what do we need to do here in Canada to improve productivity, and what is the role of policymakers in this regard?
Well, let me just begin saying a couple of words of why productivity is so critical. As Governor Nagel just outlined, there are a variety of structural factors: deglobalization, decarbonization, demographic shifts. They have the potential to create greater cost pressures going forward. And this, what do we do about that? Well, the best thing you could do would be to raise productivity and create a bit more flexibility. I mean, productivity makes your businesses more internationally competitive. It pays for higher wages. It creates fiscal space. And for monetary policy, it means the economy can grow faster without creating inflation. Low productivity growth has been a serial problem in Canada. And coming out of the pandemic, to be frank, we thought productivity growth in Canada would pick up. At first, companies were having a hard time finding the workers they needed, but as they managed to hire those workers, get them trained, supply chains started to normalize, inventory management sort of returned to normal. We thought all that should lead to rising productivity. It hasn't happened. Productivity has actually been declining in 6 of the last 8 quarters in Canada. That's why we made such a stark statement. Everything is going to be more difficult going forward if we don't get productivity growth coming up. What's the solution? Well, at one level, the solution seems pretty apparent. We have weak investment in Canada. We need more investment in machinery and equipment, more investment in new information technology, more investment in IP, more innovation, more dynamism. But the tougher question is, okay, what's it going to take to get that? Why don't we have more of those things? And there are some puzzles there, and maybe this is a fabulous business audience. Maybe I'll put a couple of questions to you. One of the two puzzles for me. During the pandemic, we saw an enormous amount of ingenuity from the private sector. Even as the economy is being shut down, GDP is declining rapidly. You were investing in new digital technologies to figure out how to serve your customers digitally, how to get your employees working at home. The manufacturing sector rapidly pivoted to create the PPE, the protection equipment that Canadians needed. How do we harness some of that ingenuity, that innovation, without having a crisis? The second thing that puzzles me is when I look at Canadian businesses in almost every sector. We have a Canadian business that is a world leader, that is investing, is competing very effectively and winning in global markets. Why? But if you look at the average, we have a lot of winners, but why don't we have more of them? What's it going to take to pull the average up? So we have all the ingredients. We can do it. We've got to sort of cut through the obstacles. And if we can increase productivity, unfortunately, everything is going to be more difficult.
Yeah, look.
I mean, maybe can I also do my short elevator pitch for the German economy?
Yes.
Because there were many reports that are saying, well, Germany is the sick man of Europe, and this is definitely not the case. I think the German economy is coming back. The first quarter was better than expected. Private consumption is coming back, investment. It will not be a year of a high growth rate, but much better than we thought 12 months ago, and it's a higher probability for the next year that the growth rate is picking up. Germany often in the past showed its capacity in a situation where things are problematic, and we showed that we have this adaptation capacity of the German industry. We have very large, very innovative companies. We have a very strong SME sector. So there is a good turnaround story for the German economy. And I know that there are so many business people around. So please invest in Germany. This was my elevator pitch.
Great pitch. Well, look, investing in people and in technology, that's the basis for strong business. And Governor, I couldn't agree more with you that we do have global champions, made here at home. And so I hear a very clear call to action to everybody here in the room, representing business as well as other members of government, and those not in this room, to really continue to take on the uncertainties. Uncertainties are always around us. We got to take them on, and work through them, as we have in all the years past in getting to today. It's a great segue into another topic, innovation. And innovation is happening at the central banks as well. So I know, President Nagel, that the ECB is thinking about innovation in very broad terms, AI, central bank digital currencies, and getting ready to do things differently. So it would be great to hear that perspective from you. And as you talk about the digital euro project that is underway, it would be great to hear from you. What is it looking to achieve and what is it not? Because I get the sense there's a lot of uncertainties, and public opinion sometimes varies on these topics. So it would be great to hear from you around that.
Thank you very much. I think the digital euro is our most important, let me say, project in the euro system for the next year. We are currently in the phase where we're trying to find out what could be the different specificities of the digital euro. What should we, is it more a wholesale or a retail digital euro? Is it a combination of both? And my understanding here is that it is, especially for the European Union, for the euro system, it is important to have such a digital currency. And I can give you maybe one reason. It has something to do with the history of the last 2 years, where, as I alluded to, we learned it in a very, let me say, tough way, how complicated it is when you are being too dependent on certain, let me say, things. And the same is true when it comes to digital infrastructures. I think the Europeans should work on their resilience. And so digital infrastructure is an important element. It could also be used as a kind of a weapon. I guess it's not maybe true here in that room that Europe has not its own cloud infrastructure. So all the cloud infrastructure we use in Europe is domiciled somewhere else, but not in Europe. So a digital euro is also something that could help us to develop on such a digital infrastructure on a European cloud solution. So I believe, taking that into account, it is really building up on the resilience it's really helping us to develop on our resilience. And I believe also, and this is underestimated by the financial industry, a digital currency is also coming with many new, let me say, opportunities. I already alluded to the retail sector, but I guess especially for the wholesale sector, it's very important to develop on new products, and this could also you can get access to new customers. And at the end, many people in Europe, they have that concern, well, it's about our privacy, and it's more the opposite. We guarantee that there will be more privacy. We respect the privacy when it comes to digital payments. And so I believe I can talk on that for the next hour, but it is clear that something like the digital euro is helping Europe to get better in terms of how we prepare ourselves for the world outside that is getting more digital. And so banknotes are an important product, but we're trying to find a product that is in a more complementary way, helping us to foster our financial infrastructure.
And so what do you see as the timeline for this project?
I think the timeline, as far as I can oversee the whole process, we're talking here about 4 up to 5 years.
Okay, very exciting. I recently read over 130 countries actually globally are experimenting with central bank digital currencies in various degrees of acceptance. And as a reference, in May 2020, it was only 35. So certainly a topic that's going to continue to be at the forefront of discussions, including the knock-on effects. We are almost at the end of the discussion, and so I have a quick rapid-fire question for each one of you, which is, what advice do you have for the audience as we look ahead? As I mentioned, we have investors, government officials, bankers, and hopefully it's an optimistic advice and tone that we could wrap it up with, but it's up to you. So, Governor, could we start with you?
Well, first thing I'm going to say is, look, you know your businesses much better than I do, and so take any advice you get from me with a grain of salt. You know what you need to do, but a couple of things perhaps I could offer. What would be some reasonable planning assumptions? Maybe that could help. First of all, you should plan on inflation in Canada getting back to 2%. We've made a lot of progress. We're going to stay the course. We're committed to finishing the job. Secondly, interest rates. Look, we raised interest rates extremely rapidly, very forcefully to get inflation down. It's been working. It is reasonable to expect, if that continues, that interest rates will continue to come down gradually. But I don't think it would be the most prudent assumption to think that they're going to go back to pre-pandemic levels. We had a dozen years after the global financial crisis to the pandemic where interest rates were unusually low. And I don't have a crystal ball any more than you do, but it doesn't seem like the most likely assumption they're going back to pre-pandemic levels. You know, some of the other things, look, the biggest thing, as Governor Nagel highlighted, look, the biggest thing that could reduce uncertainty in the world is for Russia to withdraw from Ukraine. I think the reality is there are more conflicts in the world. You're going to have to plan in a world where there's more geopolitical uncertainty. The reality is there's going to be more climate events. That's going to make your job harder. At the same time, I think we can't be paralyzed by that uncertainty. If you wait for all the uncertainty to be cleared before you make an investment decision, unfortunately, one of your competitors has probably already taken that opportunity. So yeah, don't speculate wildly, but make smart bets, manage that uncertainty, and don't stand still. Your competitors aren't. We need investment. We need to grow, and just to end on an optimistic note. Inflation has come down a long way. Growth in Canada has resumed in the first quarter, and with some excess supply in the economy, we think Canadian economy can grow without building new inflationary pressures. We expect growth will gradually pick up, and as long as inflation keeps coming down, it is reasonable to expect further interest rate cuts at some point. We'll be taking it one meeting at a time, but I feel like the base case is looking better.
Thank you.
I think it would be too easy to say, well, we central bankers, we showed worldwide our commitment to fight against inflation, and we did what we can to bring inflation down. I think this is definitely good news, so I have to reiterate on this aspect. But just to give you maybe an advice, and it's more an anecdotal evidence from something that was said by German Chancellor that I really admire, but in that case, I do not agree what he said. And he said once that if a politician has a vision, he has to consult a medical doctor. What I would like to say with this, I believe we need more visions for how to deal with all the challenges we are confronted with. And I hope there's enough optimism in this room, in this audience, to develop on these visions. Thank you very much.
Well, thank you both. Thank you both very much. Thank you both very much for your insightful remarks, joining us today, and for everything that you have done over the past several years, and that you will continue to do in ensuring that price stability is re-anchored, and that we do win in that final mile when it comes to bringing inflation down as well. Thank you once again. Please join me in a round of applause.